Well, thank you. I was really honored to get the invitation to speak with you. I had to shorten my normal talk that I've given before a little bit, but it might still be too long because I sometimes go off script. So just give me the hook if I'm going too long. I'm aiming for 40 minutes. All right, so I want to fortuitously start with this brochure for TIAA, formerly known as TIAA-CREF, which is this very large financial services company that is particularly known for managing the retirement accounts of teachers and university professors. And here is a brochure that has to do with Chapman University. And I begin with this brochure because I think it captures what we imagine, or at least what I imagine, a pension fund does, which is that it helps hardworking university professors save their pennies so that they can enjoy their retirement, walking their dogs in peace. But of course, in order to enable these blissful retirements, pension funds must take money and make it grow. And in 2007, TIAA adopted an interesting new strategy for achieving this growth. It began buying farmland, and in fact, doing so very aggressively across multiple continents. This continued to the point that by 2020, TIAA's farmland portfolio had grown to 2.25 million acres of farmland globally, worth about $8 billion. In a newspaper interview, a TIAA executive explained the company's approach to farmland, comparing it to other alternative asset classes that have now become very mainstream. He said, "This is just another asset class that has the potential of going the route that real estate, private equity, hedge funds did in the past." Now, TIAA was an early mover in this area, but it is not alone. In the years following TIAA's initial plunge, many institutional investors have gotten on the farmland investment bandwagon, including hedge funds, university endowments, private foundations, as well as many wealthy individuals as well. And it's this trend of growing financial sector investment in farmland that's the subject of my talk today. So why does this matter? Why should we care if institutional investors are buying farmland? Well, for one thing, we might think about the implications of this trend for economic inequality. This figure that comes from the 2018 World Inequality Report shows how drastically income inequality in the US has grown since the 1980s. And there are various reasons for this, but one prominent argument, most famously made by the French economist Thomas Piketty in Capital in the 21st Century, is that the proportion of national income coming from returns to wealth is increasing relative to the proportion of national income earned through labor. In other words, those who make money simply because they already have money are basically winning out over those who make money by working. Land comes into this because property is one of the major forms in which wealth is stored and can be made to produce income. So this trend of growing economic inequality is, on one hand, likely to fuel concentration of land ownership, and on the other hand, concentration of land ownership is likely to contribute to growing economic inequality. But of course, this is also important because land is not just another asset class in several very important ways. Unlike, say, stocks or bonds, it's central to food production, to farmer livelihoods, to indigenous and other cultural identities. So as farmland becomes an increasingly standard route for storing wealth and generating income from capital, there's the potential that this will fuel dispossession, particularly of indigenous communities and farmers of color who are already some of the most vulnerable to land loss. This general topic is something that I've been researching for quite a lot of years now, somehow snuck up on me, since about 2010. And today I'll start by telling you a bit, I'll actually just be telling you about findings from my book, Fields of Gold, which came out in the summer of 2020. And by the way, my favorite thing about this book is that it's actually open access, so you can download it for free. And this is thanks to UCSC Professor Emerita, Margaret Fitzsimmons, who, when she retired, transferred her remaining research funds to me. And they turned out in like the greatest instance of academic fate ever, turned out to be exactly how much money I needed to pay the press a subvention to make this open access. So thank you, Margaret. The book basically examines the changes that have taken place since 2007 or 2008 in the farmland investment industry. It asks, first of all, why has farmland recently become so appealing to investors? And second, how is farmland being transformed into a new financial asset class? Farmland, I argue, doesn't just naturally lend itself to being treated as a financial asset like any other. This, what we might call a financialization process, runs up against long-standing moral norms surrounding speculation, against issues of national sovereignty, and it even runs up against the material nature of the land itself. I'm therefore interested in what institutional changes, what ideas, what narratives are even making it possible for farmland to become a desirable financial investment at all. There's a lot I could say about research methods, and if you're interested, I'd be happy to answer questions about it. But the quick version is that most of the research for this book fell into the category that anthropologists call studying up. Rather than studying communities affected by investor land acquisitions, I was really focused on the people doing the investing. And the part of the research I'll be drawing from in this presentation included just over 50 interviews with people involved in farmland investment, who could kind of be seen as located along the farmland investment chain, from the sort of end investors through asset managers, sometimes through operating companies that own a lot of land, and that sometimes serve as the investment vehicle. And in addition to interviews, I also spent a lot of time doing participant observation at industry conferences and other industry events, which I found to be really important sites where this very new industry was taking shape and forming a collective identity. A first, I think, really important finding from this research, which may not surprise you, was that investors were largely being drawn to farmland for the financial returns that it produces. The returns to agricultural land can really be divided into two categories. First, there's the income return, or it's sometimes also called the cash return, or simply the yield, that comes from actually farming the land or from renting the land out to someone who farms it. So this is the money that the property is producing every year as a result of its productive use. And second, there's the capital gains that come from land appreciating over time. Unlike other capital assets, land does not depreciate. It tends to go up over the long term in value. And this figure shows the breakdown of returns between these two categories for one pretty typical Midwestern state, Iowa. And you can see the income return is the line, and that has been just fairly steadily trending downward, basically, since over the last 4 decades or so. On the other hand, the returns from land appreciation, the capital gains, have been much more volatile, with some periods such as the farmland boom of the 1970s, where capital gains were just massive, land was going up in value very quickly, and other periods such as the farm crisis of the 1980s, where land was actually depreciating, capital gains were negative. And you can see in this figure that beginning around 2005, we entered into another period in which land appreciation, land values were going up, land appreciation had several really phenomenal years, with the exception of right after the financial crisis. And it was only after a couple of years of these really impressive returns from appreciation that institutional investors, such as pension funds, started to really think seriously about buying land. And this focus on the financial returns from land was very much reflected in my interview data. Farmland investment professionals stressed repeatedly that a lot of the draw for them was the financial returns from owning farmland, not so much the productive returns from actually farming it. So they said things like, our annualized return on farmland investments has been between 18 and 20%. That's made up of about 15% that's coming from land appreciation. I think it is lazy to only squeeze 5 or 6% off the appreciation side. I think it's not making appropriate buying decisions. On the cash return side, we come in at around 5%, sometimes a little more, sometimes a little less. So this US farmland fund manager is expecting to get about 15% return from land appreciation and 5% from farm income. And more generally, this orientation towards land as just another source of capital gains is reflected in the way that investors speak about land. One thing that particularly struck me was how often my interview participants would compare farmland to the kind of financial assets that are more typical fare in their investment portfolios. So they said things like this: geographically, among the commodity crop properties, the lowest risk would be in the Midwest. It's kind of the treasury bill of farmland. I find statements, and I can't tell you how, my book is called Fields of Gold because practically everyone compared it to gold. I heard it compared to just so many different kinds of existing asset classes. It was fascinating. And I find statements like this really interesting because they take land, which is a heterogeneous amalgamation of soil and water and plant life, not to mention unpredictable insects and unruly microorganisms, and which furthermore is embedded in these webs of social relationships with neighbors and tenants and farm workers. And they reduce it essentially to its financial returns. They distill, or they attempt to distill, this complex, more than human assemblage to just another asset class. But of course, this is much easier said than done. Commodification of land in any context, under colonialism, under the British enclosure movement, has always been an arduous and highly contested process. And this is still absolutely true when it comes to taking land to the even more advanced forms of commodification required to enable financial investment. Researchers have increasingly shown that farmland is not just automatically profitable or attractive or even comprehensible to the investment community. Instead, it must be rendered investable, as anthropologist Tanya Lee puts it. She describes land as a complex assemblage of material and social qualities that varies across cultural contexts. She says, clearly, assembling land as a resource available for some purposes to the exclusion of others requires a great deal of complex cultural work. It involves the deployment of technologies to make land productive, metrics to adjudicate between more and less efficient uses, and inscription devices that make land into a resource for different actors. Other terminology we could use for this process is asset making or assetization are terms that are often used. And this is where my work comes in. I describe the complex work that goes into transforming farmland into a suitable financial investment. And importantly, this assetization process is not easy. One of the main challenges that this emerging industry has had to grapple with in its attempts to render farmland investable has been the complex moral values with which farmland markets are imbued. In 2012, I attended a farmland investment conference and I left the building heading to lunch with a group of attendees to be loudly confronted by protesters affiliated with Occupy Wall Street. This was in New York City. They were handing out flyers. This is one of them, or part of one of them, naming some of the attendee firms and accusing them of land grabbing. This caused some considerable angst among the conference attendees, particularly among the more public-facing organizations. So for instance, at the registration table, the woman ahead of me was actually asking, she was from a very well-known charitable foundation, and she was asking the staff to print out a new name tag for her with her organization name removed, so as to avoid the protesters realizing that her organization was there at the conference. A few years later, a coherent campaign had emerged among a group of activist organizations specifically targeting TIAA as sort of a household name and a leader in this field. This picture is from a protest I attended. I didn't actually take this picture because I'm a terrible photographer, but I was there in 2017 in front of TIAA's Manhattan headquarters. This retired college professor, herself a TIAA account holder, is giving a speech in which she rejects on moral grounds the very idea of her retirement savings generating income in a way that could result in the dispossession of peasant and indigenous communities. Her speech and the movement as a whole challenges the view of farmland as just another asset class, which is really so essential to the industry's market-making activities. In the US, the idea of investing pension fund money into farmland isn't actually entirely new. It originally emerged in the late 1970s, which was the last time that there was a really massive run-up in farmland prices. You can see this is just a figure from my book that shows the sort of three big bumps in land values over the course of the 20th century. So the 19-teens, the 1970s, and beginning around 2007 or so. And we're actually really, farmland values are really going up again as of the last year or so. So in 1977, as farmland values were rising to dizzying new heights, representatives of Merrill Lynch and a Chicago bank proposed a new fund called Ag Land Trust, which would invest pension fund capital into farmland, cornering some of the profit from this dramatic appreciation. These are a couple of news articles from the time that talked about it in Forbes and New York Times. This proposed fund, which was at the time very novel, was a complete failure. The moral outrage at such an idea was so strong that a subcommittee of the House Committee on Agriculture held 3 days of hearings about it, at which almost 50 people gave statements, and none of them, other than the fund representatives themselves, had anything good to say about this idea. In fact, in this day and age, this 400-page report that comes out of this is actually really kind of refreshing reading because it's so bipartisan. Democrats and Republicans alike agreed that it would be wrong to allow pension funds to buy up farmland, possibly driving up land prices for farmers in the process. Their statements at the hearing reveal a shared belief about the appropriate scope for financial activity in agriculture. The role of finance was to supply capital to producers, not to monopolize scarce productive assets themselves. In the US, some institutional investors, particularly life insurance companies and commercial banks, have actually long participated in farmland markets, but with a key difference. Their involvement had up to this point been mostly limited to supplying mortgages to farmers. But now institutional investors were proposing to own the land themselves. Many subcommittee members were uncomfortable with this shift. They exhorted pension funds to stick with historical precedent, expressing a view of land as first and foremost a productive asset, which should be owned by those who use it in production. So for instance, one Republican representative said, "I respectfully suggest that if our nation's pension funds would like to invest in American agriculture, they should follow the example of the major insurance companies and make direct real estate loans to farmers at current rates of interest." The fund representatives, in turn, attempted to defend themselves by reframing their land purchases as effectively equivalent to loaning money to farmers. They argued that by removing the expensive burden of land ownership from farmers, they would in effect be freeing up working capital that the farmers could then use in production to expand their profits. This argument did not go over well at all. Another Republican representative summed up the general sentiment saying, "There is nothing that lies so deep within the soul of a farmer as the desire to own his own land. I think that is really the crux of the matter and is why such an outpouring of sentiment has occurred. My suggestion would be that you go back to the drawing board and drop the idea. You really have been tinkering with the virtue of country America with this proposal." That Ag Land Trust, this proposed fund, is here construed as tinkering with America's virtue, makes explicit what was really implied throughout the hearing, that land ownership by financial institutions rather than farmers constitutes a moral threat. Its critics didn't reject it on the grounds that it would be illegal or unprofitable, but rather that it broke with traditional ideas about how the financial sector should behave in relationship to agriculture. And a few days after these hearings, the proposal to create this fund was dropped entirely. The uproar over ag land trust, I think, can be understood with reference to what Mariana Mazzucato calls the production boundary. This is the term she uses for the imaginary line that society draws between value generating producers on the one side and value extracting non-producers on the other. The production boundary is discursively constructed and its location has changed drastically over time. At the time of the Ag Land Trust hearing in 1977, we can still see a fairly general sentiment that financiers are essentially non-productive actors whose main morally legitimate role is to support the real producers, farmers, by supplying them with capital. In the decades that followed, Mazzucato shows this changed enormously. And by the time the next farmland boom rolled around in 2008, the production boundary had really shifted, not just in the realm of farmland markets, but generally in society. It had expanded, sort of what was defined as a productive activity had expanded both in the popular imagination and in metrics such as GDP to encompass the provision of financial activities among, of financial services among productive activities. However, the moral legitimacy gained by finance remains somewhat tenuous. Farmland investors today must still work hard to shore up their precarious moral legitimacy. And I found that this work continues to hinge on their ability, at least especially in the US context. And the countries I mostly did research were the US and Brazil. So this was very relevant in this context, these contexts. I found that this work still hinges on their ability to identify as producers, essentially. Though the production boundary has shifted considerably since the outcry over ag land trust in the 1970s, that shift is not definitive, and the investors still perform discursive gymnastics to ensure that they are located on the producer side of the boundary. In particular, I noticed three common discursive moves undertaken by farmland investment professionals in interviews, in public presentations, and in promotional materials. First, if the investment professional has any personal or professional connection to agriculture, that connection must be stressed for everything it's worth. One farmland investment professional I interviewed, for instance, called himself a real farmer multiple times throughout the interview. Another one boasted to me of his ability to drive a tractor and castrate a bull. Second, even those farmland investors with no hope of being viewed as farmers themselves can still position themselves on the producer side of the boundary by emphasizing their improvements to land. In true Lockean form, investment professionals implicitly justify their land ownership by stressing their plans to transform their properties, generally bringing them to higher value and more capital intensive uses. And finally, like the ag land trust representatives before them, today's farmland investment professionals still often frame their efforts as a means to support farmers. Like these advertising materials from the Canadian farmland investment company Bonifield Financial, which buys land from farmers and then rents it back to them in the form of long-term leases. Farmland investment professionals often stress how their land purchases free up operating capital for business expansion or allow aging farmers to retire while also passing their farming operations, though not all of the land, onto their children. These discursive moves, I argue, allow investors to sidestep any remaining stigma surrounding finance and rentier income in general, and to bask instead in the sort of warm moral glow associated with farming. However, the challenges of the new farmland investment industry do not stop here. At the same time as investors must work to create moral legitimacy around their own participation in land markets, they also face challenges that are just inherent to the investment object itself. Within the political economy of agriculture, there's a long line of theoretical reasoning dating back to Karl Marx in the 19th century, which proposes that the peculiar physical nature of the agricultural production process, the need to work with land, with the seasons, with plant and animal biology, makes it harder for capitalist producers to profit from agriculture as compared to other industries. which in turn slightly, the reasoning goes, protects peasant and what's sometimes called family farmers from capitalist competition. However, it's also been very widely observed in the rural sociology and geography literatures that capitalist corporations have found many ways to profit from agriculture despite its awkward materiality. In fact, the financial sector has often managed to take the material difficulties faced by agricultural producers and turn them into profit-making opportunities. So think, for instance, like crop insurance grew out of the weather risks faced by farmers. The longer I spent doing this research, the more I came to see this as one of the central tensions within the farmland investment industry. The idiosyncratic, awkward materiality of farmland and agriculture continue to pose major challenges, but industry actors are working diligently to find ways around those challenges so as to render land investable. Following rural sociologist Patrick Mooney, I'm going to refer to these as detours. And I'll give you just 4 examples to show you what I mean. All right, I'll start with this detour because it's the most basic, but probably also the most important. A huge material difficulty associated with agriculture is just the risk of working with nature. Unexpected weather events, pests, etc. These risks directly affect the profits of agricultural producers, obviously, but they could also affect the profits of farmland owners indirectly, since land value is partly based on agricultural income. However, this risk has become less and less problematic for investors, and even a benefit to investors due to the magic of diversification. In the mid-20th century, there was a bit of a revolution in investment theory with the advent of what's known as modern portfolio theory. According to this theory, investors should not focus on choosing individual stocks with the highest possible return or lowest possible risk, but should instead focus on how all the investments in their portfolio work in combination. An optimal portfolio will contain investments whose risks are unrelated to one another, so that they over and underperform under different conditions, ensuring that the portfolio continues to make money no matter what. Investors had actually really widely embraced the financial benefits of diversification by the 1970s or so. But the idea of applying this to farmland caught on only more recently. The first journal article doing this that I could find was from 1985. And even then it was written in very hypothetical terms because this kind of widespread farmland investment just wasn't happening yet. This development in financial thinking is crucial to understand this current financialized land rush for 2 reasons. First, because as finance has become the science of curating the perfectly balanced portfolio, those idiosyncratic risks associated with agriculture are no longer deal breakers. In fact, having unique kinds of risk actually becomes a good thing. For farmers, those risks are still mostly bad, but for investors with their capital spread out across asset classes, those distinctive risks of agriculture are suddenly potentially actually an attraction. Second, the lessons of modern portfolio theory can be applied within a portfolio of farm properties. So you get a lot of maps like the one I already showed you from TIAA, and showing properties spread out across a country or a continent or the globe. And in my interviews, I heard a lot of quotes like this one from an executive of a South American operating company. We are very big on diversification. We diversify by crop. That means you have different planting and harvesting periods. By region, so that the same weather event doesn't affect you in the same place. By political domicile, so that the same stupid set of politicians can't screw you everywhere. Of course, diversification has always been a central tenet of traditional and sustainable farming practices in the form of intercropping and crop rotation. But this is something very different. Now, with this approach to agricultural investing, the owners of capital can cultivate diversity at the level of their farm portfolio. And they can unfortunately do so without abandoning a commitment to industrial monoculture. The material qualities of farmland are also a problem when it comes to financial legibility. In particular, land is highly heterogeneous. 2 plots of land in different parts of the world or even right next door to each other can be completely different in many, many respects, in terms of soil types, in terms of climate, well, on different parts of the world, in terms of climate, land tenure arrangements, political regimes. And this lack of uniformity makes farmland very different from, say, soy futures or other standardized financial asset classes for investing in agriculture. And it poses a real problem for attracting non-specialist investors to this asset class. So this has given rise to something of a cottage industry in generating new metrics and figures to help investors compare farmland across the globe. For instance, these are just two figures from the London-based global real estate company Savills, which represent two different approaches to comparing the investment potential of farms in different investment locations. This one on the left is simply a visual representation of land price appreciation in several different countries, while this one over here attempts to quantify the risks and benefits of farmland investment in different national contexts. What's striking, I think, about these metrics and images is how low resolution they tend to be. The unit of analysis is often at the country level, despite the fact that countries often contain vast geographic and political diversity. But of course, taking the complex and making it simple, taking immense qualitative variation and standardizing it in the form of a few quantitative indicators is precisely the point of these types of metrics and images. It's that simplification and that standardization which gives images like this their power and utility as decision-making tools. A third big problem with land is the way that it immobilizes capital. Because land itself is immobile, land markets tend to be relatively local and relatively illiquid, meaning it's generally not a quick process to buy and sell land. And this is a big problem for many investors who are used to being able to buy and sell stocks basically on a dime in reaction to market movements. So a detour around this obstacle has arrived in the form of the publicly traded farmland REIT, or real estate investment trust. These are essentially companies that own a bunch of farm properties and that investors can then buy stock in just as they would any other publicly traded company. Investors then receive dividends based on rental income or farm sales. The first US-based farmland REIT, called Gladstone Land, went public in 2013, and there have since been a couple more to go public. This is a major detour around the problematic materiality of land because it not only makes farmland into a liquid asset that can be bought and sold almost instantaneously, but it also gets rid of the high upfront cost of acquiring land. Now, anyone who can afford to buy stocks can invest in farmland for far less than it would cost them to buy a single acre of land. This is a screenshot I just took today of Gladstone Land's performance over the last few months. And you can see that here, if you look up here, this is the ticker symbol. As the first public farmland REIT listed on NASDAQ, they actually managed to nab the ticker symbol land. So you can literally go and buy shares in land. Finally, and just really quickly, new detours are emerging all the time. This is one that recently came to my attention because of another research project I've been doing that's related to the ag tech industry. One of the major material difficulties, again, of agricultural production from the point of view of capital is just the physical extensiveness of land-based production. With the exception of vertical agriculture, farming operations are spread out over space, and this can create problems for actually knowing what's going on in your fields. The development of precision agriculture since the 1990s has largely been an effort to address this problem on behalf of producers. It allows big farm operators to visualize vast expanses of land that are far too big for them to regularly visit or experience in person. But this problem reaches a whole new level as investors are amassing hundreds of thousands of acres, potentially, often widely distributed and likely very far away from their own headquarters that are often in global financial centers. So as a result, we're starting to see new ag data startups that are specifically marketing big data solutions for institutional investors in farmland. So for instance, at a ag tech conference I attended in 2017, a data analytics company presented, which explicitly discussed institutional investors in land as among the primary clientele for its farm management services. The presenter explained, if you think about old school family farming, so 4 or 5 generations ago, you had a handful of parcels. You could manage it on a napkin. When you get to tens to hundreds of parcels, you move into the Excel spreadsheet. But then when you get to hundreds to thousands of fields, sometimes spread across the entire country, sometimes even international, you now need something like artificial intelligence and machine learning. So these types of big data startups are pushing up the upper limit of the number of farms that investors can profitably manage and the number of tenants they can effectively surveil. So I think that this is really sort of a cutting edge of farmland asset making. So I'm going to wrap up here. What I want you to take away from this talk is that there is an effort underway to transform farmland into a financial asset class, but that this process is pretty fraught with tensions. I've focused on the moral and the material constraints faced by this process, but it also faces in different national contexts, often political or legal hurdles. So this financialization of land is not a foregone conclusion by any means. However, many small farmers and farmers of color particularly already struggle to survive. And this will only be exacerbated if they begin to find themselves in competition for land, water, and other resources with multi-billion-dollar hedge funds or pension funds. So even though this trend is still kind of in the early stages and is still very contested, I think it's crucial to monitor because of how it could contribute to ongoing dispossession and ongoing farm sector consolidation. So I'm going to leave it there, and I look forward to your questions. Thank you. Any questions?
Barry, you are muted.
So I have one.
Oh, I muted. Go ahead. Okay, Jim, go ahead.
And I've unmuted myself. A whole host of them, but could you comment? You worked in Brazil, you said, on the international dynamic of this. I would think that some countries would have legal prohibitions about foreign ownership of their farmland. Is that true? Is that common? What's the dynamic of that?
Yes, yes, definitely. So that's the part that I didn't make it into this talk, so I'm so glad you asked. Yes, so several countries have prohibitions. Several US states still have restrictions on foreign ownership of land. Many of them put into place during the last big farmland boom in the 1970s. So Brazil, I found to be a really interesting place to do research because when this boom, this is kind of part of a much larger, what's sometimes called by activists in the media, global land grab. I try to, in my book, I call it a global land rush because I think grab implies illegality, which is not necessarily the case. And also because I want to be respectful of my research participants and not call them land grabbers behind their backs. So this global land rush was really, people started to notice it around 2007, 2008, that in some cases, national governments were acquiring large tracts of land internationally. This was when not only did we see the financial crisis, but also food prices were really skyrocketing around 2008. And so you saw countries that are dependent on food imports kind of freaking out, and sometimes state-sponsored enterprises were being deployed to acquire large tracts of land to produce food in other countries. And so that got a lot of international attention. Things like the South Korean company Daewoo going to Madagascar and acquiring a 99-year lease on an absolutely enormous amount of farmland from the Malagasy, the government of Madagascar. And so this is part of, I kind of focused in for my research on this aspect of the financial sector getting involved, which has very particular motivations. But this is part of a much broader trend of governments, corporations, and other actors getting very interested in acquiring farmland internationally for a lot of different reasons. And so some countries, Brazil, when I started doing this research, was just such a poster child, especially for this kind of finance-led investment, partly because it never had any kind of land reform after colonialism. So it just has incredibly concentrated land ownership. So they're just massive tracts of land owned by a relatively small amount of the population. And so for pension funds, for hedge funds, for these institutions that need to deploy millions of dollars at a time or tens of billions of dollars, that's really nice. So they were very drawn to Brazil for that scale, among other reasons. And also it's just an agro-export powerhouse. And in 2010, the Brazilian government, it was an outgoing administration of the Workers' Party, the Lula administration, put into effect a sort of reinstated an old rule that had been on the books but had sort of been decommissioned, which put limits, quite strict limits, on how much land could be owned by foreigners. And foreigners, very importantly, was defined as companies, it could be individuals, but companies with over 50% foreign capital. And so a lot of my research in Brazil was sort of looking at the implementation of this law, interviewing also, I didn't talk about this research, but interviewing policymakers and politicians about, on both sides of the debate that ensued, about sort of why was this law reinstated, this regulation reinstated, and also talking to companies about what they were doing about it. And what I really found was that, for one thing, this law was sort of a stand-in for a broader debate about land in Brazil. The target was the foreigner, but for many of the people who were in favor of this law, the problem wasn't really foreigners. It was land concentration generally. It was a lack of progress on land reform. It was bigger issues than just foreigners coming in. But foreigner was sort of a politically appealing proxy. And even more specifically, when people talked about foreigners on both sides, who was frequently mentioned were the Chinese. Although that was, as far as I could tell, and still as far as I can tell, a tiny minority of the investments taking place. And so there was a lot of racism in the way that this was reported in the media, in the way that it was talked about by politicians. It was sort of the one thing that could be agreed upon across the aisle, was that it was threatening that Chinese companies were coming in and buying land, when in fact there were maybe 2 instances that were really widely reported of Chinese companies trying to buy Brazilian land. And the main one was just canceled immediately. And most of these investments were the capital was coming from Europe or North America. So that was interesting, just that I kind of realized that more and more over time, that in many ways the specter of the foreigner was acting as a proxy because of the ways in which the law was sort of impoverished in terms of possibilities for just regulating land ownership generally, for instance, or for regulating corporate land ownership perhaps, or regulating the amount of land that any entity could own. And so another interesting thing about that was just to realize how easy it was for companies to get around that regulation. I mean, companies were just very transparent in my interviews with them and at investment conferences, just saying, oh, I'll just list for you all the ways that you could get around that law. So many. Companies just restructured their assets to create a new investment vehicle where technically the subsidiary that was buying the land had less than 50% foreign capital. and it was like the subsidiary of a main company that had a ton, like had all that technically owned all their expensive properties and had most of their capital that was mostly foreign capital. Do you know what I mean? So there were just a lot of methods like that for getting around it. And I think that's also, you know, partly a symptom of calling, like the word in Portuguese for addressing this phenomenon was estrangerização, which is foreignization. And so I think the fact that it was being generally labeled and addressed under the rubric of foreignization was really limited the response. I mean, it was problematic because it was kind of drawing on these pretty racist ideas about who these foreigners were, but it was also problematic because it just didn't work very well.
Gail, did you have a question?
Yeah, that was a mind-blowing and really depressing present, for which I say thank you. But I think because you were following out the logic from inside the investment portfolio and all the ways they decide, is this worth the risk? How do we diversify? How do we make ourselves look good? I was left wanting to know two other things. One is, how far advanced is this process, both in the United States and in the other places you studied, but especially Brazil, maybe, that is the financialization of land. Let's get out of the TIAA CREF. Let's stop worrying about our own programs here and see how far advanced this is and how big a role pension funds are playing in it. And then the other one, which you partly answered just now, but not completely, is what do you think effective pushback might look like, both on the part of states and on the part of social movements? Because somehow a TIAA demonstration up against something this complicated seems to not quite get there. It's very good-hearted, but you know, you're looking at a very large process with a lot of moving pieces, and the state piece of the pushback seems to deploy xenophobia almost instinctively. So one doesn't exactly want to climb aboard that train wholeheartedly. So I wonder if you could just take the investment portfolio piece of this and just broaden out and then look at pushback and give us some overall comments on those. But thank you for an amazing talk.
Thank you. I have a bunch of extra slides at the end of my talk that I'm thinking of pulling up, but I'm going to try to restrain myself. So on the first question of what is the extent of this, the truth is we don't know. I mean, it's been a while since I sort of searched for best industry estimates, because the best estimates are coming from within the industry because they can kind of talk to each other and figure out how much, you know, what the extent of the market is. Back in 2015 or so, or 2014, I was seeing estimates of about $40 billion worth of farmland held by these kind of large institutional investors. I would imagine it's a lot more by now. The trouble is that we don't collect data on this. I mean, so just taking the US as an example, you can, as a researcher, you can you can acquire, often paying a decent amount of money for it, parcel data, assessor's parcel data at the county level, which I've done for quite a few counties in the past. And you can see the name on the deed, basically, and you can see the sort of the local address given. But even then, those are, first of all, it's not easy to get it for an entire state. Certainly not up-to-date parcel data for an entire state. It's certainly not something you can just get for the country. And I've done research with collaborators, particularly this was led by Loka Ashwood, who's at the University of Kentucky, and John Canfield, who's a PhD student at the University of Wisconsin-Madison, where we got public records data, like paid for a subscription to a public records service, so we could trace back the name on in the parcel data to the parent company and even the grandparent company, and we could not just take like the local PO box at face value, but also look at the address of the parent company and the address of the, you know, grandparent company, so to speak, if there is one, and that was incredibly time consuming. It was basically John's entire master's thesis and is not a feasible approach to use. You could do it for sort of one county if you have a lot of time. But so we actually don't know who owns a lot of these properties. I'm doing research now with a grad student in the in the Mississippi Delta, where she's been interviewing, trying to look at intersections between these kind of investments, or a lot of investors are buying land in the Mississippi Delta and the Southeast in general, partly in response to California's water crisis, that it can grow a lot, you can grow a lot of the same crops down there and water is not a problem. And so, so I've been kind of looking up, I've been mapping different counties, trying to figure out who's there. And in a lot of cases, you just, I can figure out that certain investors are there, but only because I happen to know the names of the subsidiaries they buy the land under. Like I'm looking at a county and I'm like, oh, Midnight Sun, why does that sound familiar? Oh, I'm pretty sure that's the subsidiary that UBS Agribusiness uses when it buys land on behalf of the Alaska Retirement Management Company, or Retirement Board. And it's like, that's not, there's so much research would be involved in trying to figure that out on a case-by-case basis. So it's not easy to get this information. There is a, in the US, sorry, this is much more information than you wanted probably. There is a institute called the National Council of Real Estate Investment Fiduciaries, NCREIF, which collects data from investors themselves, from these large institutions. But they won't tell you who's on the list that they're collecting data from. And you can get a subscription to that data. I have had that data. It's something I report on in my book. And it's you can really see the amount of land owned by institutions and its valuation going up very steeply in recent years, but you can't actually find out which investors that represents. You can only sort of surmise. So basically, we don't know how big this phenomenon is. I tend to, my sort of way of characterizing it is that basically it's still pretty small. In some, for instance, there is data on just general investor land ownership, including just sort of individual investors. And in some parts of the country, in the Corn Belt, I think there's surveys in Iowa, a regular survey that happens there. And I think if I'm remembering correctly, it's maybe about 30% of land is owned by investors, but it would be a much smaller percent when we're thinking about these kind of financial institutions. So I think of it as kind of small, but rapidly growing. And on the question of, and therefore very important to get a handle on quickly, effective pushback, I don't have an answer to that. And I sometimes think that should be my next project now that I have tenure. I suspect that, yeah, I don't tend to think that foreign laws limiting foreign ownership are the way to go. There have been, many states have had, again, several of them put into effect in the 1970s, but some of them much earlier, in some cases actually in the state constitutions, laws limiting corporate land ownership in various ways. And as you can imagine, they're leaky as sieves. But there have been some studies suggesting that those laws are really effective at keeping land in the hands of farmers. What we mean, sort of smaller farmers. What we mean by farmers is also hard to categorize, but there have been studies, for instance, in Saskatchewan, showing that once restrictions of that type were lifted, there was a lot more of this kind of absentee corporate ownership of land. I also think that probably tax policy is going to be really important for this. And I don't know anything about tax policy myself. And I think this is partly why I haven't really delved into this, is it feels so daunting. But I think that, in some of these cases, like REITs, these real estate investment trusts, basically get tax breaks by there are rules around, they have to distribute 90% of their earnings to the investors. I think that's right. And in return, they sort of avoid double taxation. Probably getting that wrong, but it's something like that. And as a result, a lot of companies are sort of trying to structure them, things like prison companies are structuring themselves as REITs, the landowning portion of their company, to avoid taxes. And I'm not sure why we give tax breaks for property ownership at all. I mean, why is that a desirable thing? I think that probably taxation is going to be involved, but I don't know how. I'll leave it there before I say anything else really stupid.
Okay, there are a couple of other questions. One from Virginia Jansen and then from Roger. Sir Virginia.
Okay. First, I'll make a comment. It sounds like Back to the Future, where in the Middle Ages, since I'm a medievalist, I think of that. The peasants were tenants and were at the mercy of the landowners and had to, of course, give most of their crops to the landowners. But my question concerns is sort of related to what you were talking about. You know, what happens to our food supply and the quality of it? Because undoubtedly these investment hedge funds and so on probably like factory farms better than individual farmers. And then I'm wondering what role the farmers markets could play in the pushback.
Yeah, that's a hard question to answer. I think so. I think it's certainly true. So I think that investors have, my research suggests that investors definitely have this particular, more so than other actors. And I don't want to pretend that farmers don't think about their land as an investment, right? I don't want to pretend that it's like farmers are only driven by some kind of mythical ideal of the family farm that is only motivated by love of the land. And then there are these like autonomous, these kind of market robot, investors who just think about profits or something. It's much more complicated than that. I think, I was in the presentation saying that investors also have these kind of romantic ideas about farming, and farmers themselves are very much thinking about the value of their land. But I do think that these types of landowners are more driven by the desire to see their land increase in value than other types of landowners on average. And I think that desire motivates certain types of land uses. And in particular, there's going to be a tendency to use the land more intensively because producing more is one of the best ways to increase your land value. Sort of having higher profits from the land increases your land value. It also just increases your profits overall.
Then pushback could focus on pesticides and things like that.
Well, this is the thing, is I think that while it does overall lead to more intensive uses of land, which can be sort of kind of clearly problematic, like, mining groundwater unsustainably, or, implementing confined animal feeding operations, or it can also mean converting to organic production. For instance, there are farmland investment funds that focus on converting California farmland to becoming certified organic, because that's one of the surest ways to increase the value of the property. There are also some investors doing some sort of carbon sequestration type activities, using cover crops or, the sort of minimum tillage type activities that are sort of the low hanging fruit for keeping carbon in the soil. So I know you were asking about health, food health, whereas I'm answering about environmental health. But
no, the whole package.
Yeah. So I think that overall, I don't think it's just a straightforward line that like ownership by financial institutions is going to lead to environmental degradation. But I do think that it's going to lead to larger scale, more capital intensive agriculture. It is inherently not going to be, or I think it is difficult to make it, I will say, compatible with smaller scale diversified farming operations of the kind that, for instance, the Center for Agroecology at UCSC promotes. Simply because if you own there are transaction costs to interacting with lots of different tenant farmers, for instance. It's more profit. You're going to save a lot of money and time by having one large operator that farms a lot of your properties. You're also going to, you want large properties are more likely to be mechanized. That's just not compatible with having rows planted in different crops, for instance. But that doesn't mean that they mightn't do some of the more basic, agricultural sustainability activities that are compatible with corporate agriculture, such as USDA organic and some of the more sort of basic carbon sequestration techniques. So yeah, I don't know if that fully answers your question.
Roger, did you still have a question?
Yeah, I've got a couple of things that you have a very intriguing talk, and I compliment you on it. The first question I have is basically, how does the size of this asset class compare with something like cryptocurrencies, which I don't consider particularly an investment, but a lot of people seem to. The second thing is, I'm curious about the role of agribusiness, whether they tend to hold on to their land, whether they own it, or are some of them basically selling it and then renting it back to free up capital, basically. And then a couple questions about, is typically the land already rented that goes into the asset class? And how many people will rent the land after they sell it? So it's kind of, they're looking more at the consequences directly of that.
Okay, there were a few parts to that. I'm not sure if I will get all of them. Cryptocurrency, I have no idea. That's a great question. I don't know. I tried to Google it really fast while you were talking to figure out the size of the asset class. I have no idea. In terms of so these kind of financial, I'm particularly interested in financial institutions, but just wealthy investors as well often are buying land through these kind of agricultural asset management companies. In whether or not they choose to be directly invested in operation on the land depends, they're a varied bunch. The investors themselves are a varied bunch. I don't want to present them as sort of just a singular entity. And they may, I think their sort of appetite for risk and the role that farmland is playing in their investment portfolio is going to have a really big role in determining whether they are invested in operation or just leasing the land out. Generally speaking, just leasing the land out is lower risk. It's also going to determine lots of other things, like where in the world they're buying, what kind of crops they're planting. Permanent crops, probably riskier than row crops, commodity crops. And so many investors are only leasing the land out. Others are producing or have like a vertically integrated, or they're directly contracting with the producer, and they're a company that's producing on the land, and they are invested in that production. Often it's more, I've found that more often investors are directly invested in production when it comes to permanent crop properties like vineyards or nut orchards or berries, cranberries or something. Let me think what else to answer about that question. You were asking about the role of agribusiness. So in some cases, when the properties are rented out, in some cases they're rented out to, smaller farmers. I don't know. I don't think there's any kind of data on the sort of size of operations. And sometimes, depending on the context, they're rented out to like large operating companies. For instance, I did research in Brazil where some of the biggest actors in this are very large operating companies, to the point where the operating company itself, and here I'm talking about big agribusinesses that operate just enormous amounts of land, hundreds of thousands of hectares. They are the investment vehicle, and they sort of are the ones, they're in some cases really fashioning their agricultural operating company as a land investment vehicle to a large extent. So they're really kind of saying, come and invest in our company. We own a bunch of land in Brazil, or Brazil and other South American companies, for instance. And it's a great way to profit from both agricultural production and land ownership. So the agribusiness kind of is the investment vehicle, if that makes sense. And pension funds or other end investors might invest directly in them, or even they might be traded on the stock market, so you could just buy shares in them directly. And yeah, so it's kind of different. It's a really varied field. Other investment companies, like the one that I mentioned earlier, work directly with individual farmers to purchase land from them, and then will maybe offer them a long-term lease to stay on the land, because there's sort of this issue where in the US and probably Canada as well, farmers are really aging. And so this is another narrative used to really kind of justify this, is that we have this aging farm population and this is the only way, like there's no one left to farm the land, the children are leaving town, which there's truth to that, but there's also a ton of people trying to get into farming who can't afford to get into farming because land is so expensive. Like the expensive land is one of the main reasons that new farmers can't get into farming. So yeah, I sort of lost the thread of your question, but maybe those answer some parts of it. Do you want to follow up on it at all?
Well, okay, I think we're gonna give Todd the last question here. Todd?
It struck me that there's a similarity. In 2009, large corporations started buying individual houses, and that really hadn't been done. Of course, apartment buildings, yes, but not individual houses. And I haven't followed that. Of course, there's also a similarity of homeowners wanting to own their own. People want to own their own home, just like farmers want to own the land. So there, of course, you don't typically grow food on the house, but housing is an important aspect to it. So I was just wondering, what happened to those houses? How have the corporations dealt with those assets? It seems like it might be an interesting question.
That's a good question. I don't know what the role is of sort of what happens with the structures that are on these farms that are being purchased. And I think that the comparison in general to things that happened in 2008 with urban property markets is very appropriate. One thing that's sort of interesting about this is to think about actually how it relates to earlier developments in the timber industry, where in the 90s particularly, there's some good work by a scholar named Andrew Gunno and some others about this sort of financialization of timberland in the US, which actually really happened 2 or more decades earlier. And again, sort of as I was saying, like institutional investors are drawn to Brazil because they could get scale of properties. In the US, timberland was largely owned by these vertically integrated forest products companies. So they just, these companies that were making paper or whatever owned tons and tons of timberland as well. And in the 90s especially, we see a lot of that land getting transferred over, partly because of the sort of pressures of shareholder value reporting sort of ideas about corporate management, where it doesn't look good for these companies to have all of these assets sitting on their books. It looks better for them to sort of sell it off to investors. And partly because investors were looking to diversify their portfolios, we see a lot these institutional investors buying up timberland. But that was really the low-hanging fruit because it's huge. It's like these huge properties. And so they could really quickly acquire these natural resources. Whereas then it wasn't until 2008 that these companies start saying, all right, let's look at these little farm properties and, maybe bother with buying them. And that was partly because after 2008, it was a financial crisis, but it was also a housing crisis. So the timber industry wasn't doing great. So there was sort of some capital switching from investing in timber, or like capital that might have gone into timberland investment instead went into to farmland. And so I think I agree with that sort of analogy of this rise of kind of buying individual properties. But I don't know I don't know the answer to your question about sort of what happens to the farmhouses if it's not being rented to smaller farmers, if it is being rented to a company that's operating, or farmers that are operating several properties.
Thank you.
Okay, well, thank you very much, Madeleine. That was a really different kind of topic, something one hasn't thought about. So good luck on the book. I want to thank everybody for coming. If you haven't done your survey yet, fill out that survey for the Emeriti. Okay. All right. Thanks for everybody. And we'll see
Thank
you in
you.
January. See you in January. Okay. Bye.